Hey everyone, and welcome back to Am I Catching a Falling Knife? The show where we dive deep into stocks that are seeing some significant dips and try to figure out if there's an opportunity lurking in the volatility. I'm your host, Dave, and today we're putting Texas Instruments, ticker TXN, under the microscope. All right, so what's the story here with Texas Instruments, ticker TXN? Well, the market is currently fixated on a cautious outlook for their third quarter of 2025. This isn't just a hunch, it's heavily influenced by growing concerns over tariffs and those ever-present global trade tensions. Now here's the kicker. Even though TXN actually exceeded its Q2 earnings expectations, the company's own subdued guidance for Q3 totally overshadowed that strong past performance. That's what's leading to the stock price decline we've been seeing, making us wonder if we're catching a falling knife. So, let's unpack who TXN is, for those of you who might not know. Texas Instruments, or TI as many call them, is a behemoth in the semiconductor world. They design and manufacture chips that are absolutely integral to a vast array of electronic equipment globally. Think of them as the silent workhorse behind so many devices. They focus heavily on analog and embedded processing chips, and get this, their strategic emphasis is on the industrial and automotive markets, which together accounted for a whopping 70% of their revenue in 2024. They boast a massive product portfolio, over 80,000 products. And their revenue isn't just from chips. They also earn royalties from licensing their patented tech. Looking at their segments, analog is a huge piece, nearly 78% of revenue, with embedded processing at around 16%. Geographically, while the U.S. is their largest market at about 38%, they have significant international exposure, with China accounting for over 19% of their revenue. Financially, they pulled in $15.64 billion in revenue in their latest annual filing, with a gross margin of 58.02%. Now, let's get into the numbers. So, how did we get to that estimated earnings impact? Let's break it down step by step. First, we identified that the market narrative explicitly points to tariffs and global trade tensions as the direct cause for TXN's cautious outlook for Q3 2025 and their subdued guidance. This isn't just general economic jitters, it's a specific concern tied to trade. Second, when we looked at TXN's business profile, it immediately became clear why this narrative hits them hard. Their industrial and automotive markets, which are about 70% of their revenue, are quite sensitive to global economic shifts and trade policies. And remember that 19.26% of their revenue comes from China? That's a direct bullseye for tariff concerns. Third, when a company gives subdued guidance after exceeding earnings, it tells us there's a real, material negative impact coming on future revenue. Based on this, we're estimating a 4.0% reduction in overall revenue for Q3 2025 compared to what was previously expected, purely due to these trade-related headwinds across those exposed segments and geographies. Fourth, and this is crucial for a manufacturing-heavy company like TI, we consider operating leverage. TXN has a healthy TTM gross margin of 58.02%. Because of the fixed costs in their manufacturing, a percentage decline in revenue doesn't just reduce earnings by the same percentage. It typically has a proportionately larger impact. We've estimated an operating leverage factor of 1.8x. What does that mean? It means if revenue drops by 1%, earnings drop by 1.8%. So, finally, to get our estimated impact on quarterly earnings, we multiply that estimated revenue decline of negative 4.0% by our operating leverage factor of 1.8. That gives us negative 7.2%, which we've rounded to a negative 7% estimated earnings impact. Our confidence in this range is moderately wide, from negative 9.5% to negative 4.5%. Simply because subdued guidance is qualitative, and quantifying exact macro impacts like tariffs is tricky. Plus, our operating leverage factor is an estimate. But the company's direct acknowledgement gives us a solid foundation. So, what does this mean for valuation? To get a fair value, I ran a discounted cash flow or DCF model. I used a 5-year growth rate of 14.4%, which is based on analyst consensus, a discount rate of 9.5% to reflect the risk, and a terminal growth rate of 2.5% for the long term. Under a base case scenario, without factoring in the narrative-specific impact, this model gave us a value of roughly $130.94 per share. However, when we apply our narrative's estimated earnings impact, particularly the anticipated revenue hit and its flow through to earnings, that fair value adjusted down to approximately $118.50 per share. Remember, the current price is around $214.92, so there's a significant gap. For those of you looking at potential entry points, if TXN continues to be a falling knife, some custom buy levels we've identified are $150, then $135, and finally $120. These are points where the risk-reward might start to look more compelling if the stock continues to decline towards its narrative-adjusted fair value. And that wraps up our deep dive into Texas Instruments, TXN, for today. As always, this podcast is for informational and entertainment purposes only and is not financial advice. Please do your own thorough research and consult with a financial professional before making any investment decisions. Thanks for tuning in, and I'll catch you next time.